Whenever you see a financial crisis, I can assure you negative convexity is lurking in the shadows. The capital markets are like this Wile E. Coyote moment. They keep going off the cliff and don't look down. I suspect the credit markets are in that phase. We have seen what the government will do when they get their back up against the wall. They will put that Fed funds rate at zero. They will start buying treasuries. Do I think that'll happen again? Not likely, but it could happen. And if everything goes haywire, you're going to want something to protect yourself.
Welcome to Monetary Matters. I am joined today by Harley Bassman, managing partner at Simplify Asset Management. He's also known as the Convexity Maven. Harley, thank you so much for joining me today.
Thank you. Good morning.
I've been reading your stocking stuffers every year since I came across them. I think it's probably been over 5 years now. It's one of my favorite things that comes about in December because you give your macro view and then you also give some trades. You are the convexity maven, so many of them are usually bond trades. So they're outside of the sort of equity calls that a lot of managers and research providers are making for their 2026 predictions. Why don't we just start out with the macro view? The main thing that I would take away from reading your stocking stuffers this year is higher for longer, and that despite the cooling of inflation, you are not buying it.
I've been pushing back on, team transitory for quite a while now. I think inflation is here. I won't say it's here to, well, it's here to stay. At 3% ish, somewhere in that zip code. I don't see 2% coming back anytime soon. I don't see 9%, but I think that there's an underlying core that's going to keep pressure on prices, on wages. Won't get out of hand, but it ain't going to 2%. The key drivers really are demographics, as always. Boomers are retiring, and thus you're pulling skilled labor, experienced labor out of the market, efficient labor, and replacing it with less experienced labor, so it's more expensive. The thing that is tricky that some of my cohorts have pushed, the idea that when you retire, you spend less. And there are some academic papers that show that as you get older and you retire, you spend less. And I'm sure that's true for the cohort they looked at, which was my parents' generation, the Depression generation, the less wealthy generation. The boomers, we took all the money, man. I'm sorry to say. I mean, we got the stock market, we got the housing, and we have plenty of wealth. And there's all this talk of this transition of wealth from the boomers to the millennials. It's going to happen, but we're going to spend a bit of it on the way. I think you're going to see continued spending, maybe even more spending by the boomers as they retire and have more free time. And of course, the millennials, they're in the household formation stage. And you did see household formation lag about 10 years ago. All the talk of the boomer guys sitting in the basements of mom's house, which was true. But what's different is they get married later. Average first child in New York is 31, in San Fran's 32. And what you've seen is household formation picking up and catching back to trend. And so I think those two things are going to underpin it. And then finally, immigration. I really don't care what you think about immigration as a good policy or a bad policy. You're welcome to think whatever you like. But GDP is people times hours times productivity, right? People, hours, productivity. If we reduce the number of people, we reduce GDP growth, and that's it. And if you think it's a worthwhile venture to have fewer people in the country and also suffer the cost of less GDP, that's your opinion. You can do that. I'm fine with that. Let's remember, when you push out people, you're going to go and push out growth. And one of the reasons why the US has done so much better than Western Europe and Japan and everywhere else, is we've had significant population growth and they haven't. And that's just the pure bond math of how it works out. So I think all these things kind of underlie a slow rising of prices. And then finally, of course, fiscal policy. I mean, we're spending, 6.5% fiscal deficit. This is utterly insane to happen during a time of, almost full employment, and we're not at war. And I don't foresee any change in that. There's no support for cutting back on fiscal policy from the Democrats or the Republicans. And so if we're pumping out that kind of money into the system, fine for the stock market, fine for GDP, but also, fine for inflation.
So you're saying you don't see a world of 9% inflation. Do you see GDP being above this 3% inflation? Are we going to enter into stagflation, or is this going to be just sort of running it hot with high growth as well as stubbornly high inflation?
If the government is running a 6% fiscal deficit, that's good for the economy. It's not good long run for the U.S. dollar or things like that. But I mean, that kind of comeuppance takes decades. I mean, Japan took them 30 years for them to blow up the currency. I think it could take quite a while for us to have a downside there. But it will happen. It's just a matter of time. My big prediction in bond land is 4.35% 10-year rate. That's what I said last year. That's what I say this year. And I get that from, I think the funds rate goes to, call it 2 7/8, 288. You slap on 147, which is the 30, 40-year long-term funds to tens. I think that's the level. Well, can we go up and down around that? Of course we will. But I mean, I think that's the center of gravity. If we have a 5%, 5.5% nominal GDP, okay, then that kind of lines up. Chicago, the thought is that you have rates somewhat near nominal GDP because rates are the cost of capital, and therefore, if you can't make a profit, you're not going to borrow money, right? So there should be a small profit there, right? So you have a 5.5 nominal. 5.5 nominal is what? It's 2.5 real, 3% inflation. There you go. So I mean, day trading around that, ridiculous, but as a long-term profile. And I think the front end comes down. I think the Fed will reduce rates, maybe politically driven, maybe otherwise. Maybe it's just to go and slow down the growth of the interest payments. So right now, most new bond issuance is front end, and we're borrowing front end. The Fed can pull it down to reduce the interest cost. That's fine. Back end, the Fed can't control. Let's go to QE, and I think they're not going to do that again. They already had enough problems with that. So a curve steepens, which we'll probably hit to on page 5 or 6. The usual is funds at a level plus 50 for twos, plus 100 from that for tens. That's kind of the old wives' tale for bond traders, and so that's how it all lines up for me.
Okay. So we're at what, 4.12 right now? So you're calling for the 10-year actually to sell off despite the expectations that people have for rate cuts. Do you think that is because of this fiscal profligacy? What is it that has you, other than just your historic fair value for bonds, that has you thinking that the long end of the curve is not going to fare well in 26?
This massive supply of bonds. I mean, we're just pumping them out there, and the U.S. currency is being harmed by what we're doing, and we see it with the price of gold and housing and everything else. Everything that's not fiat currency, and of course, that's the last thing we're going to talk about is gold. I'm not a gold bug, but I do think that you want to own gold, man. But we'll get to that later on.
Yes, we certainly will. So do you think that the weakening of the dollar is a policy goal of the current administration, or just a consequence of their actions thus far?
I think they're probably happy with it for the trade deficit, but I think the main driver is they just want to flush money in the system to get votes, and they don't have the stomach to go. I mean, they can't cut back on Social Security or Medicare. Well, they can. I mean, I'll tell you what's going to happen is they're going to means test the big programs. So if you make over a certain amount of money, you don't get it, or you get less of it. And maybe they'll go and uncap FICA, Social Security, so bring in more money that way. But I just don't foresee, general destruction of the big social benefit programs being changed for the vast middle class, and that absorbs so much of the economy already of the budget. And since they can't cut that, I'm not sure what else they're going to go and cut. So we're going to be running a deficit for quite a while. And that's what they want to do. I mean, who wants to go and be the guy who takes with a punch bowl and cuts benefits to people? No one wants to do that. They should do it. They've had opportunities for decades. I mean, Simpson Bowles was a beautiful policy that would have solved this thing. I mean, the last person to go and take this on was Bill Clinton, warts and all. And that was the last time we had a fiscal surplus. So I'll tell you a story that in 1998, 99, 2000, the Merrill Lynch government bond trading desk was worried for our jobs because we thought they were going to stop issuing treasuries because we actually had a surplus, right? Sounds insane now, but I
Yeah.
mean, we actually thought that was a possibility. And if Bush 2 had not, done the tax cut policies back then, we might still be in that kind of flight plan.
So it's interesting you talk about means testing. We can somewhat have a mashup here of your work and the work of your colleague Mike Green. Where do you think they draw the line for that means testing?
Oh, 140,000. I don't know, probably higher than that. Probably higher than that. Um, but it'll be somewhere. I mean, they'll figure it out. There'll be a number. It'll be top 10% of income people is a good starting place.
I saw a stat recently that said like one third of Social Security receivers are making over $100,000. And I imagine that's mostly dividends and income from investment portfolios, not that we have a bunch of retirees working high paying jobs. I'm sure there's certainly some high paying members of the Social Security receiving demographic, but I imagine a lot of that is just if you have a big enough portfolio, you're going to be spitting off six figures in income from dividends and coupons.
It's called Social Security, but the original was an old age and survivor benefit. I mean, this was for people who were, desperate back in the 30s. I mean, 65 years old in 1936, demographically, is 83 years old now. Can you imagine having people work till their age 82? Kind of crazy, isn't it? That's what it was. And we never moved it. We should have been advancing it slowly over time, but we didn't. And thus here we are, and people have become to rely upon Social Security as a core means of retirement, as opposed to being a backstop versus their savings. Once again, a public policy mistake, which is understandable because who wants to go and make people work longer or things like that. I mean, we backed ourselves into a corner, and then of course the pig in the python is the baby boomers. We also did not expect 1936 to have this giant bulge of population in the late 50s, early 60s. And that is the real problem, is this demographic bubble bursting on through. If we somehow find a way to survive to, 2050, we'll actually be okay because there'll be a massive drop in that population as, people like me kind of go off into the sunset or under the sunset, I suppose. But I mean that is how these projections all work. I mean, demographics is baked in the cake. The people who really are in trouble ain't us, and we're in pretty big trouble right now. It's China. Their 1.3, 1.4 billion will be 800 million in like 40 years as the one-child policy percolates through the system. And I'm not sure how you're going to take that population down by a third and not have real problems there. But that's their problem, not our problem. I'm focused on the U.S. and what we're doing. And we're the cleanest dirty shirt, as Bill Gross said. As big a problem as we have, other places have worse problems. And so you don't see the dollar really declining versus the yen, the euro, the other stuff, because that stuff's even worse than we are. But we are declining. Fiat currency is declining versus assets, and that's just bond math. And I'm a U Chicago guy. I'm Milton Friedman. I know my partner, Mike Green, pushes back on me all the time with that. And look, he's smarter than me. He's better looking than me, but he has been wrong on rates.
I'm going to ask you to go into his realm a little bit. And first, before we get into bonds and rates, let's talk about equities. The other way people save for retirement beyond relying on the social safety net is increasingly 401ks, and that ever present passive flow continues to be on. It seems to me from reading your work, you believe that until that stops, the equity market is going to go up. So is your call for 2026 that those trends reverse, or that we continue to have passive flows pushing equity markets higher?
I think Mike is dead right on this. He's the world's expert on this. He started 10 years ago. He knows it better than anybody out there and tells the story very well. And in my stocking stuffers, I do have a link to his like a 30-minute presentation he gives, a condensed version, which is terrific. And everyone should understand what's going on here. Look, I have 4 kids. What do I tell them to do? I say, you have jobs, you're at corporate America, and they have a 401k plan, and they'll give you matching of some percentage, and it invests almost immediately. Just max that thing out, take the free money, and go like, 70, 80% SPX, and the balance in some 5-year, high grade bond fund, and reinvest divs. Call me in 30 years. And that's the advice I've given them, and I don't see what's wrong with it. And so if everyone's doing that, then you have money every month or every quarter, whatever it may be, going into these 401k plans, and they are all basically they're going index. There's no reason not to. They're going index, and when they go index, they go proportional to the market cap, good, bad, or ill, and the market cap of the top, 8 companies is a third or so of the market, and so they get most of the money. And the trick here, as Mike will detail and prove, is that these large companies are kind of inelastic, meaning that a company that's 100 times bigger than the smallest company, $100 going into them will move that stock much more than only $1 to the smallest company. And that's why you get this kind of repeating pattern of money coming in, stocks going up, and the biggest guys getting bigger and bigger. And until we get a recession, and in my piece, I posted 5% unemployment rate, basically the idea being that you'll stop putting money into your 401k when you have no job. It kind of makes sense. Why 5%? I made it up. But it's some number higher than this where people start losing their jobs. They stop putting in 401ks, and the flow of money doesn't go in anymore. And then you have the boomers taking money out because they have to, and that will turn the tide. Will that cause a crash? Not right away, but if we start getting 6-7% unemployment, then yeah, you're gonna have a problem there. So I think the whole thing makes sense to me, and as long as we're running a 6 and change fiscal deficit, I don't see why the economy can't keep doing well. We just had a shockingly strong fourth quarter. I guess the answer is yeah. Gun to my head, I'm bullish still, or at least not bearish.
You made it pretty clear you don't think that we're going to reach that 5% level, certainly with the immigration policy providing some protection for the labor market as well as the deficit spending. Is there anything that would concern you that we could hit that 5% unemployment level or perhaps higher?
It would be a recession causing the need to fire people. And yeah, if we really deport, millions of people, that's going to impact the economy. There's plenty of papers out there talking about the different levels of immigration deportation, and the theoretical. The Peterson Institute has a nice paper on that you can go and read. That would certainly cause problems there.
Let's get into more of your forte, and that is the mortgage market. So I remember last year, and it seems to be in the stocking stuffers again this year, newly issued mortgage-backed securities. So can you talk to me a little bit about why you like mortgage-backed securities and specifically the new issues?
There's a lot of stories right now about, bankruptcies and how that has not bled yet into the credit markets, the public credit markets. A lot of the reason for that is that so much is going private now, and there's no mark to market on that. So you have a bit of a disconnect between the quoted CDX, junk bond spreads, credit spreads, and bankruptcies. Will that play out? Unclear. But what I do know is that if I can get a fancy yield, a higher yield with zero credit risk by buying mortgage bonds than by buying, investment grade credit bonds, I'll take that trade. And you still have, IG credit is plus 50-ish, and mortgage bonds are plus 100-ish. Okay, I'm picking up 50 bips with much less risk. What is the risk? A mortgage bond is kind of like a covered call on a treasury. It's not that, but it looks like that. And so you get a high, if we stay in the same area, you get a higher yield because you sold that call and you get the income from that. How do you lose in owning a mortgage bond? If rates drop tremendously, mortgage bonds will not go up that much. They'll stop going up at 103, 104. They're effectively being called away as people refinance. So if you think rates are going to drop hard, mortgage bonds ain't for you. But if you're in the idea that we're going to be in this 3.5 to 4.5, 5% area, I'd prefer to own mortgage bonds than something else. And what's interesting about the product I created is that it only buys the newly issued mortgage bonds trading near 100. The index includes maybe 60% of these old bonds created in 2020, 2021, 22, which have 2.5, 3% coupons. Much lower coupons, much longer durations. If you compare the newly issued mortgage bonds versus the index, the returns have been about the same, yet the volatility of the index is 50% more because of the longer duration. I think everyone needs to have some kind of anchor of, I, I guess, bonds, but really safe money. And newly issued mortgages have a duration of like the 5 year, maybe a little less than that. They pay five and change coupon. Um, and you can get that money quickly and easily. Trades like water, and there's no credit risk. These are government guaranteed Fannie Freddie bonds. They're bulletproof. I mean, if you think Fannie and Freddie are going to go bankrupt, you should get a gun, cans of tuna, and gold coins, because that's where we're going to be.
How do these newer issued mortgage-backed securities have less duration?
Well, let's structure a mortgage bond as you buy a 10-year treasury at 100 and sell a 3-year call option against it struck at 105. We can go down 1-for-1, but it can only go to 105 before it stops out. That 105 strike has a lot of negative duration to it because it stops you from going up in price. So the package together might be a 4 to 5 year security. An older mortgage bond like a Fannie 2, it's trading at a dollar price of 80, yet the call feature on it is still 105. Well, a 105 strike call on an $80 price bond is worth like zippers. It has no impact on the duration. So these low coupon 2.5%, 3% bonds, they trade like, like almost like 10-year securities because the call feature is almost worthless. And that's why they have lower yields, is because the call feature is so slim. But also you have, if rates go down, they will move in price on the way up. So once again, the story is if you think you're going to have rates dropping tremendously, you're supposed to buy, low coupon mortgages. But you know what? If you think rates are going to go down, just buy 10-year treasuries or something else. Buy TLT. If you really think rates are going to power windows down, you should not be fooling with mortgage bonds at all. You should be buying long duration assets.
And so I'm looking at the year-to-date return. I'm seeing that the mortgage-backed security index actually outperformed, and this was as of the end of November as well. The investment grade index and the bond aggregate compared to those newly issued MBS, as you pointed out, with much lower volatility, lower Sharpe ratios, lower yield to duration. Is that related to the market pricing in those rate cuts? Is that why you think those particular indexes and asset classes outperformed newly issued MBS?
No, it's because rates went down from December 31st last year to now. It's just that simple. If you take the snapshot, if rates back up 50 from here, then new mortgage bonds will do better. It's strictly a duration thing. That's the whole point here is if you want duration, this ain't the thing for you. But if you look at the interest you've earned, either the dividend you get paid or the total return, and divide that by the volatility of the asset, this is by far the best one out there. So on a risk return basis, it's good. And I think that anyone has a need for low duration, high coupon. Look, you buy mortgage bonds, you're not getting rich. Okay? Go and buy NVIDIA for that. But you will need some money put aside where it's easy, safe, quick to get to if you need it for some reason. So you're not forced to go and sell your equities at a low point. So you always should have some money in cash equivalents, and bonds, just as a matter of pure portfolio management.
Well, let's move on then to some of the trades that might have some embedded leverage into them. You like ultra long dated bond options for capital efficiency, both on the long and short side. Why don't we start with the interest rate hedge?
This was the first product that I came out with when I joined my firm. It's basically the reason why I came out of retirement to kind of get working, such as it is, again, was there was an SEC rule change that allowed people to put derivatives, futures, options, swaps, into ETFs. That's the magic. And we got an ISDA so we can trade professionally like PIMCO, State of California, Prudential Security. We're even footing with all of them. We were able to put a 7-year put option on the 30-year treasury, well, the equivalent of that, into an ETF, a duration of like -40. I think it was the highest return ETF in 2023, up like, I don't know, 100 and change percent. because rates went up and bond prices went down. If you want to get a hedge where you win if rates go up, bond prices go down, this is it. You need very few dollars. Remember, the ag is like a duration of 6, positive 6. So if rates go down by 100, this thing will go up by 6%. This hedge has a duration of negative 40. So you don't need that much to go and hedge out the risk in your portfolio. Um, am I advocating it? You should do it. Well, not really, because I'm not sure rates are going to go up to 6%. But there are people that do think that. And the people that are very concerned about a lot of stuff. There's nothing on the planet like this. My goal is to build very fancy, fast sports cars and have you drive it. I'm not going to drive the car for you. You can have your own opinion. But if you want to go and make money, if rates go up, this is it.
Given the deficit spending that you're talking about, do you see a world where we do cut rates and the long end continues to rise?
Oh yeah, I think that's going to happen. Clearly, I think tens are going to 435, right? So,
Yeah.
and I've always said that's coming down. So clearly, I think of a curve steepener of twos coming down and tens and bonds going up. Are they going to go escape velocity? Are we going to have a Liz Truss moment like they had in England a few years ago? No, but could it happen? Yeah, I mean, there are no zeros in the world. There's always a probability of something happening, and buying insurance. I mean, look, when you buy car insurance, you don't expect to crash your car. You have it so you can drive your car and feel safe. When you buy life insurance, you don't hope to die, but you have it for other reasons. This is an insurance product, plain and simple, and you don't need that much of it to go and buy insurance for yourself. So that's how I view it. I'm not going to convince you to buy it. I'll just say if you have that view, this is what you want to own.
So it is effectively a put option on the 30-year that expires in June of 2032 with a strike at 5.45%. So does it
Effectively, yeah.
does the 30-year need to hit 5.45% for it to make money, or would it make money on the way there?
Oh, it'll make money all the way there. I have a profile in my commentary of how it'll perform instantaneously. I mean, it's a negative 40 duration, so it'll move, 40%, rates go up by 100, more or less. And we will never get to expiry. When we get 2 years from now, 3 years from now, I will take that 2032 option and roll it out to 2035. So it's not going to go away. I'll keep rolling it, and the reason for that is more technical than we care to talk about right here. But this thing will not be going to the grave at expiry. It'll be managed over time.
And then, as you say in your piece, that perhaps the more interesting trade is the other side, the bond bull, which is owning calls on not the 30-year, but the 10-year, but still at that similar expiration timeline of 2032. Why do you think that that's the more interesting side?
We have seen what the government will do when they get their back up against the wall. They will put that Fed funds rate at zero. They will start buying treasuries. Do I think that'll happen again? Not likely, but it could happen. And if everything goes haywire, you're going to want something to protect yourself. When we saw the big COVID crash, stocks, bonds, gold, everything went down. And they went down because people were levered, they needed cash, and they sold whatever they had, they sold. This will go the opposite direction. If we get rates down hard and fast, this thing will go up hard and fast. And so what you can do is you take this thing, you buy a little bit of it, 10, 15%, and put the rest into a junk bond vehicle or closed-end fund loan vehicle, some high yield thing like that, which has a very low duration. And this basically buys back all the duration. But better than that, it buys back the convexity. Remember, if you own a treasury, that's zero risk. They're actually positively convex. Let's ignore that. There's zero convexity. Everything else that yields more than treasuries, you are short an option. You're short a duration option, a credit option, a timing option, some kind of thing. You're short some risk. That's why you're getting paid more than treasuries. Okay, there is massive positive convexity in the bond bull, and that massively offsets the short convexity you have in these other various instruments. So combining the bond bull with with our credit product, which is great. Mike Green manages that; it's unbelievable. But combining those two together is a very clever trade because you're buying back all the convexity. You get a high coupon right now, and if things go haywire, what you're going to see happen with, for lack of a better word, junk bond products is they might say they have a 3, 4, 5 year duration, but if all hell breaks loose, they're going to go down in price. They'll go down in price because that credit option is going to embedded credit option that you're short is going to widen faster than the 5 or 10 year rate comes down. And so you can see the price actually go down. So what I recommend is you overbuy the bond bull to the index if you buy it with credit products. And that will basically self-insure yourself against, haywire. And then of course, if things really go down, and you can see this from the profile that I have on my commentary, this thing really goes to town. I like this one a lot. It has a lot of interesting features that are too much detail now to go into, long vol and the curve and everything else. But it's a clever idea. And overall, both these products are happier now than they were a year ago. And the reason for that is implied volatility has come down substantially. I mean, the MOVE index was trading 120, 140 a year ago. Now it's in the 70s. You've seen implied volatility on options that expire in 5, 6, 10 years, which no one else sees. You have to be professional to see that. But that volatility has come down by a lot for a lot of reasons. And thus you've seen those two as a package together. We're trading like 105 to 110 this summer. They're trading like 90 right now. And the reason for that is not rate, it's not curve, it's implied vols come down. Well, when you buy either one of these two, you are buying implied volatility. You're buying Vega. You're buying something where the price goes up if volatility, if the move or the VIX goes up, these can both go up together. I'm not advocating that you buy them as a package. I'm just saying that either way, you'll get an extra boost if things go haywire, either much higher rates or much lower rates, because vols will rise as uncertainty rises. So you'll get a double banger for both of these.
And I see in your profile, you also compare to just owning the 30-year and strips, zero coupon bonds. Why do you like this profile compared to owning those other high duration bets that would be also very sensitive to a downward movement in interest rates?
They both have much longer durations, so they will go up. The bond will go up in price much faster for a given rate move. But the bigger deal is the convexity. Because it's an option and not a treasury. And you can, if you look at this thing, you can see the convexity in there. Strips also have pretty good convexity compared to treasuries. But the bond bull is massively more positively convex. And so, up and down 50, they kind of are, they're kind of similar, but you start going down 100, down 150, then things really explode on the bond bull. And so you need to buy less of it to get the same bang for your buck. So anyone that's buying into these long duration ETFs, and they're buying it for the duration, for the safety idea that rates will go down if bad things happen to the stock market, the bond bull is a much better trade for you, just because you could put many fewer dollars into the product to get the same performance profile, which basically frees up that capital to do other things, make other investments, and that's the capital arbitrage. Is you need fewer dollars to get what you want, giving you other dollars to do more things.
Now, you say both pay a dividend since long-dated options decay slowly. Help me understand that. I think of being long an option, you're going to have to pay a premium. So are you getting positive carry somehow with these?
Believe it or not, you are. The reason why is that when the options we buy is a little complicated. I apologize. They're set up to where we don't buy the option today, but we give the suitcase full of cash to Goldman or Merrill or Morgan Stanley in 7 years. We agree to do that. There's reasons why that happens, doesn't matter. So basically all the cash that I have from people who buy the product, I have to invest this in treasury bills or other very safe instruments that are kicking off a yield of 3.5%, 4.25%. The option is a 7-year option. Options decay at the square root of time. Square 7 to square 6 is a very small number. square 1 year to square half a year is a very big number. That's why you see people generally sell 1 to 3 month options because they decay very quickly. They have massive what's called theta, massive income. People like that. 7 year option does not decay that quickly. And so the combination of that very slow decay for a long dated option, plus the income I'm picking up from owning the cash investment, that actually creates a small positive carry for these investments. Not a lot, but it's not negative, which is what you would expect ordinarily when you buy an option security. So this is basically a futures type contract where we've agreed to a price, but we're not going to pay it until expiry. So that's the difference. The price is already known, the date's already known, and so I'll pay you in the future. So I have all the cash. Same with my pork bellies now, or gold futures contracts, or anything else that's a futures contract. You agree to the price today, but you don't pay till a settlement.
Is this feature of them having positive carry always true, or is it something about this moment in time?
It's this moment in time. If rates went down by a lot, so the front end went back down to 1%, and the back end was up at 5%, there would probably be negative carry then. So it was the shape of the curve, and when the curve was inverted, there was a significant positive carry. I mean, we're talking 3-ish% returns on these things because I was earning 5 on the cash, and the back end was decaying very slowly. So yeah, there's a huge curve component there. That's a very clever observation there.
And so was this a feature when you first came out with the product and you said, hey, I have this idea, I want to put a product together for this? Was this feature present at that time and it has been present ever since, or truly like this moment right now?
When I first came out with it, rates were at zero. I mean,
Yeah, right.
there was no income on the cash. So over as rates went up, it became a goodie. But the concept's always been, I want big duration, positive or negative, and I want positive convexity. Each move, either way, I make $1, they make $1.50, they make $2 for each move along the way. That's the convexity. Convexity means unbalanced return, that it's not linear. It's non-linear in your favor, like this, right? Short an option looks like that, right? You lose money at an increasing rate, which is why we had various financial crises over time. Is whenever you see a financial crisis, I can assure you, negative convexity is lurking in the shadows. This is it's one of the few places you can go in the investment world and get significant positive convexity that's not a 1 or 2 month option.
So are you overweight one or the other personally right now? The bond bull and the interest rate hedge?
I'm actually long the hedge because I own a lot of long dated callable muni bonds, so I'm kind of buying that risk back. But I do own other long instruments that make money, so I'm kind of balanced in the whole process over here. I mean, I have a personal ISDA, so I do some pretty fancy trades that civilians can't do. My goal is to go and take a lot of the trades I do personally and professionally and put them into ETFs so we can offer professional products to civilians. And so far, these are the ones that we've figured out ways to do. Most people can't buy mortgage bonds, by the way. It is very, very difficult for a civilian to buy a mortgage bond. In fact, it's very difficult for most professional managers to buy TBAs, mortgage futures, that we do. You need to have a lot of documentation for that, and it's hard to get. And we have everything, which is our structural advantage in the market, is that we have all the documentation to trade like the professionals do. We are an institutional entity that basically passes along that value to civilians.
What's an example of a trade that either you don't think it's suitable for civilians in whatever wrapper, or you just haven't been able to figure it out that you would do in your personal account?
In theory, you could do some of the trades I do on the futures exchange, but they're kind of dirty. It's been basically making a bet that the front end is like the 2 year, the 1 year rate, the 2 year rate are not going up, and they're not going down that much. They're kind of going to glide on in to where they are. And so I put on basically I put on a levered put ladder. Where
Okay.
I'm long a 3% put, I'm short a 3 1/4 put, and I'm short a 360 percent put. And that got put out for 1 year. That got put out for zero cost. You could do it on the futures exchange theoretically, but then you got to post a lot of margin, and it's very dirty that way. But a lot of stuff it can be done there. It could be done in theory.
And with a trade like that, are you like fully covered on the risk profile because you're long
Oh
the?
no! If the Fed took rates up by 100, I'd be a sorry camper.
Okay.
But I also own my interest rate hedge behind this. So I'm kind of long the front end and short the back end. I mean, you're getting down the road here. I mean, people might like to hear me what I'm doing, but that's what I have on is basically long twos and short 20s.
Let's move to a different area of the bond market. We talked a little bit about the move towards private credit. You have as one of your trades high quality front end leverage funds. Now, not all of these are credit vehicles, but one of them is business development companies, which participate very heavily in the private credit market. So, what is it about BDCs right now, as well as some of these other front end leverage funds, that makes them attractive to you?
The whole idea is the Fed's going to take rates down, not to 1%, but take it down. And as they take it down, they're going to steepen the curve out. They're going to get the short-term borrowing rate less than the 5 and 10-year investment rate. The problem you've had with a lot of funds in the last 3 years has been the cost of borrowing has been above the investment. So the leverage is actually detracted from your investment. I think that the Fed's going to take rates down, maybe crazy, but probably not. And as that curve steepens out and you get the 1 year rate and the 3 month rate under the investment rate, having leverage 2 to 1, 5 to 1, 7 to 1 is going to be advantageous. This is why you see a lot of the mortgage REITs that do the simple trade of buying Fannie and Freddie and Ginnie bonds, and they lever them 7 to 1. That's why they're trading over book value in anticipation of the curve steepening and their income going up. A lot of the BDCs, I'm talking the quality BDCs, not the junky ones, the quality ones that buy top of the capital structure, first lien, capitalized loans. You see them trading under book, maybe 15%. The reason why is they kind of know the book is fake, right? This is the problem we have with private credit. And you saw this with the Blackstone, BlackRock, whatever fund it was 2 months ago, where
Oh
they had
yeah.
a loan in there that went from 100 to 0 in one day. I can assure you that didn't happen. It was trading at 90 and 80 before it got to 0, but no one marks it. So people are very suspect about what's in these books. So the market's pricing these loans in at 80, 85 cents on the dollar. If I'm buying, into a high quality fund with a 15% discount already built into it, and they're going to start, lowering the borrowing cost, I kind of like that. But I like it for lots of. I mean, mortgage REITs. If you want the leverage, I like that too. Muni bonds, closed-end muni funds are trading negative 8 to 12%. As that front end comes down, you're going to see these bonds trade over NAV because the yield will pick up. The leverage works for you in a steep curve and against you in an inverted curve. We have a product where we do 5x the 2 year and 3x the 7 year futures contract.
Yeah.
Those products right now are looking more interesting because the front end rate's coming down and making it so the cost to borrow is soon to be less than the investment you're getting, the investment yield. Oh, the 7 year one's already there. Cost to borrow is already underneath the 7 year rate. 2 years not quite there yet, but one more Fed cut and it will be.
So, how do you determine what is a high quality BDC?
It's pretty well known what credit quality the BDCs go into. I mean, they advertise that. A lot of the large ones basically say they have pricing power and they have first look at a lot of stuff, and they have pretty solid management. I'm not going to start naming names over here, but they're the same names you always see in Barron's coming up, and they tend to buy high quality. There are a few large ones that invest in second tier paper. They have a higher yield. I wouldn't touch them. I mean, they'll probably be fine, but I don't want that. I'm happy to take the lower yield, a little lower yield, and you can get 9, 10% now with some of these things. and you're first in line to get your money back, um, I'll do that right now. I'm nervous about credit for a lot of reasons. Um, Immigration being the primary one. I'm not taking credit risk right now. I want that to play out before the number of bankruptcies we have right now. Actual bankruptcies has risen significantly in the last year. Um, that's a real number. The fact that the market hasn't priced it in yet doesn't mean a whole lot. I mean, the same thing in the mortgage crisis. We saw the mortgage market kind of blowing up, and mortgage bonds didn't blow up for quite a while. A lot of the capital markets are like this Wile E. Coyote moment. They keep going off the cliff, don't look down. I suspect the credit markets are in that phase, but the higher quality paper is fine. The low quality stuff, different story.
Now, when I go through your stocking stuffers, there are certain trades that, as I said, I recognize from the year before. Some of them, like I know that these 7-year options, like you believe that there's, a structural oversupply of them just in general. It seems like the type of thing that perpetually is going to be on your radar. Certainly BDCs have gotten a lot more attention this year and have sold off more recently. At what point in time did that trade start to get on your radar? And how do you think about your stocking stuffers in terms of these are ones that are happening right now, and these are things that I like the risk reward potential almost perpetually?
As the Fed started cutting rates, that's what it was. Once you got the front end rate down enough to where leverage was not a hindrance, it became more interesting.
Do you see the credit concern then as just gravy, making the entry price more attractive, specifically for the high quality paper that you're talking about?
Look at the price of ARCC. I mean, it's gone from 22 down to 19 and change. I mean, and they're the biggest and the best one out there. That's your signal that the market is pricing it in. It's become more interesting. These would not have been interesting to me, 6 months ago. Agency, Annaly, you're seeing the front end come down versus the mortgage rate. So the coupon is looking like it's pretty solid now versus before it was kind of squishier. And so these are all basically, look, that whole section is about, I'm saying to you, it's okay to buy financial leverage because the curve's steepening. And it's probably going to steepen a little more. Not 2%, but they get down to 3.25, 3.5. That's fine. And I've already told you my long-term number is 288. So not this year, not next year, but that's the idea. So I don't mind owning leverage there. And I think the back end is going to keep going up. Not a lot, but all these leverage plays all make sense when the curve gets steep. And so that's kind of the prediction.
So you said a lot of this private credit stuff, you're not seeing it in CDX pricing. As you said, you have a personal ISDA. You get to look at things that other people don't. Are people trying to price some of this risk in off the market products that maybe you get to see that we don't?
I am seeing people have interest, and we are putting it in some of our funds of taking the other side of this trade of I guess buying CDX, whatever you want to call it. You win if spreads widen.
Yeah.
Low 50s for IG and high 2s, low 3s for HY. Those are like record lows, or in that zip code of being 10th decile or 90th decile of price. That your risk return is kind of in your favor, and the actual bankruptcies are rising. So I think we're going the right way on this, and it doesn't cost you that much to go put these hedges on right now. So I kind of think that, am I predicting a credit crash? No, but would I rather be short than long credit? Yes. That's why I like owning mortgage bonds.
Let's move on to one of your next trades, which is Big Oil and MLPs. So I know a lot of people avoid MLPs just because of the structure, and not everybody is used to or enjoys getting K1s every year, but you like MLPs. What is it about them right now that has you interested?
MLPs are, I mean, they're for a problem of riches. Okay, it's for high income people in high tax brackets. There's a massive tax advantage to a K1 because basically your taxes get deferred till the day you get out. So if you buy a $20 MLP and it makes a $2 distribution dividend, you pay zero on the $2, but your cost basis goes to 18. So if you then sell it someday at 20, you take a $2 capital gain. So it's very tax advantage, but it's also dirty. The bigger concept is I just like oil, and frankly, I'm thinking about coal. I just don't see how we're going to go and satiate the demand for energy in the next decade. It ain't happening by wind and solar. On board with global warming, all good with that, but you you need baseline power. You can't just turn these toys off at night or when it's raining or when the wind's not going. You need baseline power, and that's going to be nuclear, gas, oil, maybe coal. I mean, China's doing coal. Um, and so I kind of think this notion of oil going with the dinosaurs away, I don't think that's going to happen in the near future. And so I basically have the whole energy complex. I like nuclear. That's a very long term trade. But that's the basic idea. And MLPs are a fine way to go and have an income vehicle. If you're younger, you probably want to buy some kind of oils outright, buy the equity, get the longer term capital gain, longer term profile. But for geezers, MLPs are a fine way because I'm more interested in income than I'm in capital gains right now.
Obviously, the price of oil has been under pressure. When you think about the entry point and the price that you can get right now, have they been trading down? And is it maybe more attractive than it was at the beginning of the year?
They're not cheap anymore, but they're reasonable. MLPs got absolutely obliterated 2013, 14, 15. They went up when the oil spiked up, and they started misallocating capital, to put it nicely, and basically burn themselves to the ground. And I actually wrote about this a number of years ago. One of my commentaries where I advocated buying MLPs, and which it did work eventually, but I will say it took a while. Um, and they've come back from their lows a lot, but a lot of them are still well below where they were a number of years ago. And if you're getting a tax preferred 8, 9, 10% yield, um, what's wrong with that? I mean, we're talking not the last 5 years, but over horizon, you're talking nearly long-term equity returns for an income vehicle based upon the notion that I like oil. If you don't like oil, or if you feel that it's not a business you care to personally support politically, that's okay. But I mean, you go look at the Philip Morris Altria bust up, 15, 20 years ago? I mean, Altria stock since the settlement has beaten the S&P, even with Google and Alphabet and everyone else inside of it. Okay, since that bust up, I mean, no one wanted to buy smoking. Okay, that's your politics. That's your view. I'm talking strictly as an investment professional, and I think oil is as a relative percent of the index, everything else. I think is a place I'm happy to be invested in.
When things start to become uninvestable, that is a sign that you should maybe take a look. I went to a talk with Brad Jacobs, the serial sort of acquirer. He always has these roll-up companies, and he said that he went to his consultants at the banks and asked them, what sector should I roll up? And they said, well, on a price basis, oil. That's what you should be rolling up, but you can't get any funding for it. You can't do it. So he went on to number 2 in his list just because it was literally uninvestable. He couldn't get the financing. So I guess, is there any equity risk at all in these MLPs? Do you have to worry about terminal value reinvestment risk from the partnerships?
They are fairly dirty animals in terms of continual capital spending to either maintain or to expand. There's a bunch of ratios out there, free cash flow and enterprise value that could help you make a decision. Are they focused on liquid oil or on natural gas? I prefer natural gas for these things because I think that's going to be that's the easy source for these data centers.
Okay.
But I mean, look, there's plenty of research on these things, and I think it's publicly available, and you can do your own research on these things. And I tend to own the safer ones, and some of the really safe ones really never got that hurt. Some of the more leveraged speculative ones have been more volatile. But once again, it's your choice. You want to earn an 8 that's pretty solid, or earn a 14 that's going to be a little risky. Okay, I mean, once again, pick your poison. I tend at this stage of the game, I tend to pick the more conservative trades. I mean, getting a tax preferred 10% yield sounds equity like to me.
And when you say safer, you're just looking at leverage.
Leverage, and if things go south, they're not going to get cooked, and their capex budget is more reasonable. within the confines. Their price sensitivity is less. Things like that. Their legal exposure. They're not, I mean, when you're drilling under Indian lands, I guess that there's some risk to that. I own one of those, and that's always the headlines go back and forth all the time.
All right. Well, let's go to maybe the stocking stuffer that has been the trade of 2025. Many are still saying it's going to be the trade of 2026. That is gold and precious metals. So, as you said, you do not think inflation is going away, maybe not going to 9%, but certainly not going back to 2%. Is gold your favorite way to position for inflation?
Let's be careful about inflation. It's not inflation that I'm really bugged about, although I think it's there. I think it's the devaluation of fiat currency. Okay, Buffett. Look, I'm not. He's smarter than I am, clearly, but he's dead wrong about gold being an asset. It's not. Okay, it doesn't make a product. It doesn't deliver oil. It doesn't cure cancer. Okay, it doesn't have income per se. It doesn't have a dividend. It's an alternate currency. The same way as if you go and get yen or euros or rubles or anything else out there. It's a currency, and it's a hard currency. It's not being printed by anybody. There's no liability against it versus the government. And the amount of gold that's produced every year is relatively slim. I mean, it's kind of the Bitcoin story. I mean, what is Bitcoin? I mean, it's sold as basically digital gold. My problem with Bitcoin is that, well, we'll skip that for now. Bitcoin might go to 1 million before it goes to zero, is my thought. But gold is just an alternate currency. I think you should definitely have an allocation to gold. 5 to 10% is probably the number. Yeah, and just put it away and call me in 10 years. I mean, you can't trade gold per se. I mean, I've owned gold since 2010, 11, 12, 13, and I haven't sold any of it. And the return you got in the last year is just basically the previous 10 years happening in 1 year. That's how gold works. It's just kind of these things that kind of goes, and then it just jumps. Clearly, the U.S. kicking Russia off SWIFT did a lot. The U.S. Pushing back on China, well, that's kind of pushing back on it. So you have central banks are buying as opposed to selling now. But I just think in general, it's an alternate currency, and we can see right in front of our eyes what's happening with the U.S. debt. We have too much debt. And the only way you get rid of it, well, you can grow out of it after World War II, but let's take it off the table. You default or you inflate. We're not going to default, so we're going to inflate. And that's a fine strategy. And the Fed's that's why the Fed was going to QE and everything else, 15 years ago, was to create inflation. Now the idea was to create wage inflation. That didn't work. The inflation went to assets instead of wages, but we did get the inflation, just the wrong inflation. And if you want to look at our politics the last, 8 years, I will point to that as the problem, is the wealth creation went to the rich and we widened out the wealth gap to back where we were in the late 20s. The Fed, it was a good idea. It just didn't work. They had good intentions, didn't work. We had asset inflation, and so we've widened the income gap, and that's created these what I would call desperate politics for people, and they're not crazy. It's unfortunate, but they're not crazy, and we have to go and somehow put the toothpaste back in the tube on this thing. But I think the Fed's going to go, and the government's going to go and support this slow inflation that can, over time, grow the economy above the debt over many years. So inflation is the strategy, and therefore I want to own gold as some kind of alternate currency.
What about some of the other precious metals? Obviously, silver has been grabbing the headlines with its spike in volatility and pretty incredible return. I think it's up over 150% this year, just the spot price alone. Do you ever play in these other metal markets, or are you purely focused on gold?
I'm just gold. I mean, you could make the story of gold versus any of the other metals out there. You can look at copper, but I mean, copper is really an industrial metal. Not, I mean, gold has a 5,000-year history of being a currency, and the old story is an ounce of gold finds a fine man's suit. So you could buy a toga, you could buy a suit of armor, you could buy a Xenia suit, and it's all 1 ounce of gold. So there you go. And I think that gold has a history of doing that, and that is the idea here. I'm not trying to think too hard over here. Yeah, you can go and trade these things, and if you bought silver, a year ago, you've made a bloody fortune. But I'm not thinking that hard. I'm just saying, my core idea is, we have fiscal profligacy that's debasing paper currency, and I want to go and invest in something that's going to go and be the other side of that trade. That's what gold is.
All right. Well, I want to close with one of my favorite comments from you that you put at the end of everything you write, which is sizing is more important than entry level. So let's talk about sizing of all of these ideas and portfolio construction. How are you thinking about putting them all together into a portfolio?
I think number one is you have to go and break up the high risk versus low risk, basically it's stock bonds. And you can put some money into other things also. But the bigger idea is you want to go and buy something, you want to buy enough of it. So if you're right, it has an impact on the overall portfolio. I mean, if you're investing pennies in something, this doesn't help you at all. But you want to be small enough so if you're wrong, and you will be wrong plenty of times, it's not going to go and stop you out. You don't want to get in a situation where you're forced to liquidate other investments. So and that just means you have to go and look at yourself in the mirror and go, what can I tolerate? Where would I get stopped out on something? And where would and how confident am I in things? Try and time the market. I mean, you can go. I mean, what I would do. I mean, buy half now, and then you can time the market with the other half. But if you like an idea, just do it now. I don't think timing ever works for people. I mean, you could look at the whatever. I mean, even before all the index nonsense, historically, active managers never beat the index in aggregate. And I don't believe I'm any better than anybody else at timing the market. I think I'm pretty good at interest rates and other things over a 3 to 5 year horizon. But tomorrow's price, I have no idea, and I'm not putting myself in a position to go and trade on that.
All right, Harley. Well, we'll leave it right there. Thank you so much. Anybody can find the full stocking stuffers on the Convexity Maven blog that you write as well. I'm sure there's plenty of stuff over on Simplify's website. Thank you so much for joining us.
Thank you very much. Have a good day.
All right. And to everybody else, if you notice, I'm not Jack Farley. One thing that's coming from us in 2026, I'm going to be hosting a few more episodes of Monetary Matters. There's so many great people out there like Harley that Jack simply does not have the time to interview. So I'm going to be stepping in. Thank you very much for welcoming me in 2026 as I step into Jack's shoes a few more times than I did last year to host Monetary Matters. I'll still be hosting Other People's Money, where I talk to fund managers about their businesses, but you'll be seeing me more on Monetary Matters. So thank you to everybody as well for listening.